Listen, it doesn't matter where you are in your business, you can get qualified for some type of funding. There are different types of funding available out there that you probably don't even know about. And here's the best part. You don't have to wait until you fully established to get started. That's why in this video, I want to share with you 7 different types of business credit that you can apply for and get approved for. It just depends on where you are in your business, which is super important. So let's dive right in and let's talk about it. Okay, so the first one I want to talk about is vendor credit. Now, what do you call it? Trade credit, vendor credit, business credit, it's all the same. But vendor credit is when you take your brand new LLC or an established LLC and you go to other companies and you open up lines of credit with those companies. You might have heard me talk about this before. If you already subscribed to the channel, if not, make sure you subscribe, make sure you like, really help out the video, really helps me to produce more content. But these companies include well-known companies that I'm sure you heard of: Quill, Granger, Uline, Staples, Wise Business Plan, even gas cars, right? You heard of these companies before. But here's the great part about it. When you are establishing business credit, as long as your business is properly structured, it's relatively easy to get approved for vendor credit. And here's why. Because the qualifications when you're applying for vendor credit or business credit, right? Same thing. It typically only requires EIN only, meaning it's based off your business credit profile alone, not based off your personal credit profile or your business income, meaning you can easily get approved. However, there are some limitations. Vendor credit only takes you so far because these type of trade lines are considered non-financial trade lines. And non-financial trade lines primarily help you build out your pay debt score. Now, your Dun & Bradstreet or your pay debt score is connected, right? It's one of the major business credit bureaus out there. You have Experian, Equifax, and your Dun & Brad, aka your pay debt score. The challenge is that most banks don't really focus on your pay debt score when determining if your business is bankable. In fact, they can care less about your pay debt score, if I'm being honest. Now, this leads me to the next type of business credit I want to cover, which is called credit lines, or a better known, aka unsecured business credit cards. Unsecured business credit card is what I like to call business funding. See, business funding is different than business credit. Business funding is when you take your brand new business or an established business, and you also take the business owner credit, aka your personal credit, and you go to other financial institutions or other banks to open up lines of credit or credit lines with those banks. Banks that include players like Chase, American Express, PNC Bank, Bank of America, Wells Fargo, your local credit union, or any local community banks. Now, here's the great thing about business funding is that when you fill out that business credit application, there's no proof of income required. This means you can project your business revenue, or you can project your business income, or you can state your business income on that business credit application. So this means you don't have to provide any type of financials upfront, P&L statements, bank statements, etc. Now, here's another perks about unsecured business credit cards. They come with 0% interest for a limited time. 6 months, 12 months, 18 months, just depends on that bank. Now, this makes an excellent option for short-term investments. But keep in mind, when you're dealing with 0% interest, they don't last forever. Credit card interest can be extremely high once that introductory period ends. It's critical that you have an extra strategy in place so you can pay off the balance before that higher interest rates kick in. Are you tracking? Now let's talk about business lines of credit, which is, by the way, my favorite. A business line of credit is similar to an unsecured business credit card, but it's often even more flexible. See, with a line of credit, you have access to a set amount of funds that you can borrow from as needed. That's the best part about it. This means you don't have to go through extra steps like using liquidation methods from a credit card to get cash. It doesn't take all that. Instead, with a line of credit, you can easily transfer funds directly from your credit line to your business checking account or to your personal checking account, giving you quick access to working capital. Let's talk about the approval process, because a business line of credit is different from a credit card when it comes to approval. It can be a little bit more challenging because some lenders may want you to take a deeper dive into your business financials. So you might have to show proof of income. You might have to show documents like P&L statements, tax returns, bank statements, and they may even want to know your bank rating number. However, the requirements can vary depending on the banks or lenders. So you can get away without showing any documentation, just depending on that relationship that you have with that financial institution. Next, let's transition to a business loan. When it comes to a business loan, you're going to need quite a bit to become bankable, right? Let me break that down, because business loans, there are different types of business loans you can apply for, including SBA loans, short-term loans, micro loans, and traditional bank loans. However, it can be a bit tougher to get approved for a loan with your LLC, especially if it's brand new, because most banks typically want you to be an established LLC, meaning they want you to be in business for at least 2 years. They also want to see some type of solid business plan, right? Along with proof of income and strong personal and business credit scores. More importantly, they will focus on your FICO SBSS business credit score, which is the standard scoring system that banks use to determine your business credit worthiness. Next, let's transition to a different type of product, revenue-based loan. So a revenue-based loan is a fantastic option for businesses that have consistent revenue. In fact, what makes this type of loans unique is that primarily they based off your business revenue rather than your personal or your business credit scores. This means that if you have a steady cash flow, all right, it's all about the cash flow. If you have a steady cash flow coming in, you can be eligible for the loan even if your credit isn't perfect. So you can have a low FICO score, like a 580, 620, and still get approved. Sometimes they don't even check your personal credit score, hard or soft poor. But here's how it works. With a revenue-based loan, you essentially borrow a percentage of your future sales. So lenders will evaluate your business monthly revenue to determine how much they're willing to lend you as a business owner. The great part about these type of loan is that the repayment is tied to your business revenue. So the loan payments, which fluctuates, is based off your sales. If your business has a slow month, your payments will be lower. On the other hand, if your sales spikes, your payments can and will increase. Now, overall, if we have strong, predictable revenue and are looking for flexibility in our repayments, then a revenue-based loan could be a good option for your business. So just keep that in mind. Moving on to equipment financing. Now, equipment financing is a great option for some business owners. If your business needs specific equipment to operate or grow, but you don't have the capital to pay for it all up front, whether it's like machinery, maybe vehicles or some type of technology, or even some essential tools, equipment financing allows you to spread the cost over time. This type of financing is ideal for businesses in industries like construction, transportation, which I know about, or technology, essentially any industry where equipment is critical to a day-to-day operation. So for example, if you're in the trucking industry or the limousine industry, but let's say trucking, you can finance a truck instead of paying for it in full, allowing you to get started, generate income without massive upfront expenses, making equipment financing easier to qualify for than other types of loans. Now, if you default on the loan, the lender can seize the equipment. That's what they're using as collateral, which reduce their risk. Lastly, let's talk about invoice finances. Now, I've used every option here except invoice financing. But here's how it works. Invoice financing lets you sell your unpaid invoices to a lender for immediate cash. Instead of waiting for customers to pay you, you get a percentage of the invoice value up front. And once your customer pays, you receive the rest and minus, right, any type of fee. This is great for businesses with slow paying customers or loan payment cycles. Now, the best part is based on customers' creditworthiness, not yours. So business credit or personal credit is not involved. However, keep in mind that the fees can add up. So it's important that you ensure your customers are reliable. As you can see, no matter your situation, there's an option available to you. Whether you don't have the income coming in, or you have bad personal credit, or you haven't established any type of business credit, or you haven't been in business for 2 years, there's still a solution. Even if you haven't filed your tax returns, there's still an option for you.